Hi guys, welcome to this video. Today we're going to be talking about how the Fed impacts the stock market using monetary policy. The three key ways that they impact the stock market through monetary policy is through interest rates, money supply, and exchange rates. So interest rates. Interest rates are the cost of borrowing and return on savings. Therefore, if interest rates are lowered, in which they have been recently from 1.7%, 1.75% in January to 0.25%, we've seen a large cut in interest rates. This means that people with savings accounts are getting a lower rate of return on savings, and also for businesses it is a lot cheaper to borrow. The cost of borrowing is a lot lower, so people are more inclined to borrow. Therefore, the Fed lowers interest rates when it wants to stimulate the economy. So businesses and consumers borrow and spend more. Higher revenue and net income for businesses, so it leads to demand pull inflation. As more people demand more things, the demand shifts to the right, meaning that we have a extension in the supply, and we have an increase in the price level. Share prices will rise, and potentially will have price to earning multiples will outperform the estimates as demand increases massively. Okay, however, it's not always that simple. Interest rates don't always mean consumption and borrowing increases. In relation to the current economy, job prospects are a massive well, if people feel like they are potentially going to be out of a job in the coming year, then there is a lot of uncertainty. So currently, in the last 3 weeks, it was announced that 16.7 million unemployed in the US in 3 weeks. So this many people have lost their jobs in the last 3 weeks. That means these people won't be borrowing regardless of whether the interest rate is 10% or 0%. They don't care what the interest rate is. They're not going to be borrowing, and they're not going to be consuming more because they're worried they don't have a income. But also people who are in a job still, there is a lot of uncertainty in the market. They might feel that they might be made redundant in the upcoming months, so they're going to be saving as much as possible, and they're not going to be increasing their consumption, so it doesn't always work. The money supply, a government, well, the Fed will increase the money supply to stimulate the economy. These are all expansionary monetary policies to try and boost the economy, trying to speed it up, because we've seen a huge slowdown due to all this unemployment. So the money supply, if the economy is beginning to slow, the Fed may try to increase the money supply through it uses quantitative easing. This is buying back bonds to release liquidity back into the market. Interest rates are low, and more money in the economy should lead to a rise in investment and consequently a rise in aggregate demand. However, if there is a lot of uncertainty, as I said before, it's quite a main point for all these monetary policies. If there's lots of uncertainty, businesses don't care what the interest rate is. They're going to be focusing on growing. They're not going to be focusing on growing. They are going to be trying to cut costs as much as possible, as they don't know what is going to happen in the coming months. They might begin to start making more employees redundant. They try to cut costs as there is a shortage in demand. They're going to try and save as much cash for a rainy day if worse comes to worse, as they don't want to go bankrupt. This is the liquidity trap. The liquidity trap basically is saying that interest rates, when they fall, it should mean that there's a huge increase in investment. However, there may not be, because the investment demand is inelastic, so that means that it will be irresponsive to a change in interest rate. Exchange rates. When interest rates are low in a country, people will move their money to another country with a higher interest rate to get a better rate of return on their money. This is called hot money outflows. It increases the supply of the currency, depreciating the value of the currency, meaning exports are now cheaper for other countries, so they will see a boost in net exports, increasing the aggregate demand and therefore growth. This will mean that the US businesses will see an increase in demand from other countries and therefore should boost their share prices as the valuation increases. However, in this coronavirus state, other countries are also going to be affected, and other countries are also going to have a lack of demand, and they're not going to be demanding these goods from the US, and they won't be demanding them from their own country. So this is why the global pandemic is going to be a huge issue, and we'll see the full effects of it in the next coming months. But yeah, so that's all for this video. If you liked the video, please hit the like button, subscribe, leave a comment if you've got any questions. Thanks for watching.